Hey there, everyone. Today on the final bar, the S&P 500 choppy after today's CPI numbers, finishing just slightly above yesterday's close. Mega caps like Amazon holding up just fine, but stocks like airlines starting to really feel the weight of higher crude oil prices. Finally, we'll have Julius Kempenaer of RRG Research here live in our Redmond, Washington studio. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action, as always, using the best practices of technical analysis. The technical toolkit was really created decades, if not centuries ago, and has evolved over time. We've certainly modernized it over time, but at the end of the day, the founding principles, the original analysis of price and volume, trend and momentum, breadth and sentiment, while we've had greater capabilities, while we've had better access to data, at the end of the day, the analytics, the process is very, very similar. I had a great discussion earlier this week with David Cox of Raymond James. Talked about keeping checklists by hand, and I would encourage you to use whatever medium, whatever tools and capabilities you need to make sure you have a disciplined process of analyzing the markets. But I certainly hope Stock Charts is a part of your analytical process. We have a great opportunity to analyze the message of the markets as best reflected by price data. Interesting day today. I think there's a lot of anticipation about inflation data, CPI coming out before the open today. Coming in sort of in line with expectations, but still above the Fed's target of 2% year over year. So what happens now? We're in uncertain times, and so the S&P, the NASDAQ, chopping around quite a bit. At the end of the day, not really making much headway to the upside or downside, but there is a lot of activity under the hood. And today on the show, we'll hit on some of the groups on the move to the upside and others on the move to the downside. Let's get right to our market recap and talk about what happened in the markets today. Before we bring up some of the market averages and the charts, I want to answer a poll question. We asked you recently, where will Bitcoin be 1 month from today? And I love these questions not only to get a sense of where the sentiment is from our viewers, but also to force us all to think about these as four very possible scenarios. There is a very likely scenario that the Bitcoin is up 10% in the next month. There's an equally, I think, likely scenario or a possibility that it could be at least 10% down. What would that mean if you have a position in Bitcoin, in GBTC, a Bitcoin trust, or something like that? Quite a spread between the responses, but if you look, more votes for the downside than the upside. Let's bring up a chart of Bitcoin and see how this actually plays out on the chart. Here's where Bitcoin is at currently, just above 26,000. I quickly drew about a 10% up move, which would take us just below 29,000. I also did a 10% down move, which would take us around 23,500. So if you voted at least 10% higher, which about 21% of you did, that would basically mean about here, about middle of October, we're over 29,000. Now that's not to the recent highs around 31,000, which my colleague and today's guest, Julius Kempenaer, has talked about, I think, very eloquently about this range-bound environment for Bitcoin. That wouldn't be a new high for the year, but certainly would be in a much stronger position than we're at today. We go 10% lower, that gets us down toward 23,000. That undercuts the range we've been in over the last 6 months. And while that's not the end of the world, I definitely would see this current price action as a consolidation phase. What I always try to remind you is anytime you can kind of draw a rectangle around the price action and it pretty much captures what you're seeing on the chart, that usually is a great way of illustrating a consolidation phase. Buyers and sellers are basically in agreement, and we're just overshooting and undershooting that equilibrium value, which is currently around 28,000 or so. So interesting question. Thanks so much for responding. I'd probably say between 0 and 10% higher. I'd probably see Bitcoin in this range, but I certainly would put it in one of those middle camps. I think there's a lot of choppiness and uncertainty. At the end of the day, that often results in a sideways trend, not up, not down, but sideways, that third very painful direction. Thanks so much for answering that poll. By the way, if you're not seeing our polls, make sure you subscribe to our YouTube channel. Of course, go ahead and do that right now while you're thinking about it. Like this show if you could at the same time. We'd very much appreciate that. And also follow us on social media, and you won't miss the next poll. Getting to the major averages today, the S&P up slightly. And again, a choppy session, nice rally going into the last 30 minutes of trading or so, puts the S&P just below 4470. That's up 0.1% from yesterday's close. The NASDAQ composite up a little bit more, about 0.3%, and the more value-weighted Dow, I guess as I would describe it, down slightly to 0.2%. So end of the day, for a huge day with a lot of potential catalysts for the markets moving higher or lower. If that CPI number came way far away from expectations, we really didn't get there. At the end, it was sort of a waiting for Godot moment, if you know your English literature, sort of just waiting, right? Sort of a holding pattern and no real, catalyst going to the upside or the downside. Mid caps and small caps both down 0.6% around that. So we continue to see small caps underperforming. And again, it's been an underwhelming experience for small caps in 2023. We were asked in our live Q&A earlier today about emerging markets, EEM. And if you look at the chart of emerging markets, you look at the chart of US small caps, very similar sort of pattern, kind of the sideways, choppy, range-bound pattern. No real breakout either direction. I think until you see that, it's still a wait-and-see sort of moment. The VIX continued to push lower by quite a bit today. VIX is actually down in the 13 range, 1350 by the end of the day today. Again, when I think about potential danger signs, right? When the market is in a certain configuration, you're looking for signs of something different. And one of those signs of something different I think we have not seen yet is elevated volatility, right? The VIX is often considered the fear gauge, what I like to call the uncertainty gauge. That just tells you how comfortable people are with the current environment, how stable those prices are. When the VIX spikes, that often happens when the market sells off, because when people get nervous, when people get uncertain, they tend to act rashly, they tend to panic, and they panic sell, and that's what causes a push down in prices and a spike up in volatility. We are not seeing that yet. We're also not seeing a rally in defensive areas of the market, which I'll talk about with today's guest, Julius de Kempenaer. Let's continue on with other asset classes. Kind of an interesting day for fixed income as well. Bond yields actually opened up after the CPI number quite a bit high. Bonds actually opened lower, but came up through the course of the day. The TLT actually ended up flat for the day, right around where we closed yesterday's session. Interest rates overall moved down, but not by much. 10-year yield still around 425, long bond yield around 434, and the dollar index, again, essentially unchanged from yesterday's close. Looking at commodities, a bit of a mixed bag of sorts. The DBC is a little more energy biased, has a little more of an energy weighting, up about 1/3%. Today, gold and silver prices both down. Silver, down quite a bit, around 1%. Natural gas prices, the worst performer. The energy sector did not have a particularly good day relative to previous sessions where it's been at the top of the list. Finally, in our poll question, we actually asked about Bitcoin. Cryptocurrencies moving higher today. Bitcoin up 1.3%, just below 26,000, we'll call it 180. Ether prices just above 1,600. And again, I'm a big fan of big round numbers. And if you look back on the charts of Bitcoin and Ethereum, you'll find how often those big round numbers are almost magnets for the price, what we call a pivot point, right? An important level of support and resistance that we often kind of come back to, and it ends up having meaning for the markets. 1,600 has actually been one of those marks for Ethereum. I would argue 2,000 is kind of that big one. Same with Bitcoin and 25,000, 30,000, maybe even 31, sort of that big level of resistance, a confluence of resistance, if you will. Until we get above those levels, I don't think you can declare those charts in a broad uptrend just yet. It's more of a sideways holding pattern. Finally, looking at sector movements, kind of interesting on a day like today, where the market sort of had a nice rally, finished up slightly higher, but not by much. Utilities, the number one sector, and we've seen this actually a number of times recently. The top sector over the last couple weeks has often been one of two: utilities or energy. It has very rarely been some of the growthy sectors, and very rarely been other of the defensive sectors, and certainly not things like industrials, materials, and healthcare. They've often been kind of in the middle. Utilities and energy appearing more and more on the top of the list. And in my head, that makes me think to start to look in those areas to see if there are opportunities, right? As again, one day with utilities at the top is not a new trend, but multiple days of it being at the top of the list means the relative strength is starting to improve. And if you look month to date, utilities actually outperforming the S&P just fine. We'll try to look at as many of those charts as I just sort of alluded to as we can as we continue on our market recap. Let's check in with the day on the chart of the S&P 500, the daily chart. And when we were talking on the YouTube live Q&A earlier today, just a couple hours ago, I was struck by the consolidation sort of appearance that you see, right? Someone asked about the S&P being in a pennant pattern. It's not an ideal pattern only because it would be, a true pennant pattern has sort of like a big range here, and then it kind of narrows in there. This is a little bit choppier than I would, and a little bit more sparse than I would probably look for, if that makes sense. You look for multiple tests of the upper end and the lower end, but you're certainly seeing a consolidation. I think it's not a mistake that the S&P is kind of trading right around its 50-day moving average for the last week. As a matter of fact, we first reached the 50-day moving average about a month ago in mid-August. And from there, we've kind of chopped around, but we're still kind of there. So what this tells you, and what it tells me, is we had the initial pullback, and now we're sort of in choppy wait and see mode. And I don't think from this chart you can openly declare whether the next move, how we resolve this pattern, is higher or lower. I wouldn't be surprised by either. But what's really good about a chart like this, whether or not you label it a triangle pattern or a pennant pattern, is that you can actually draw some really clear trend lines. So for example, this would be the trend line connecting the recent highs. And again, when we break that line, all that tells you is, well, it doesn't say we're going to go to S&P 5000 in the next couple days. It does tell you that this pullback is most likely resolved to the upside. On the other hand, if you could look at this trend line, if I drew that maybe a little less painfully, here we go. Draw that trend line off of the lows. As long as we keep holding that trend line, this is a pretty good measure of a reaction rally off of the mid-August low. When we break that, again, not the end of the world. It's not saying we're necessarily going to S&P 3600, but it does tell you we're having an initial breakdown of this trend off of the low. So if this is a pennant pattern, we're right about at the point where this usually resolves, and there's no built-in guarantee as to which way that will resolve. By definition, it's a consolidation pattern. I would tell you, this is one of those really important times to look for a break one way or the other. And I'm thinking of work by John Bollinger and others who really talked about volatility in their work. And if you look at what John Bollinger has written about volatility using his Bollinger Bands, a period of lower volatility, the bands kind of come in because the market is less noisy. It's sort of settling down. That's usually the calm before the storm. And then there's that big move out. And so in a period like this, you just wait and see which way the market breaks. And more often than not, that momentum thrust is the next leg in the markets. I'm afraid that that's going to be down. I'm concerned about whether this breaks down and then what sort of downside objectives we need to talk about. But I'm also equally emotionally prepared for it to go higher and for this uptrend to continue, in a surprising seasonal point here in September. But again, it's always a possibility. Thinking through some of those different potential outcomes and how you would rate those probabilities, and then just thinking through what that might do to your portfolio, now is a really good time to have that thought process. I wanted to take a minute, if I could, and just look a little bit at sector performance. The way I was going to do that is go to my dashboard. I have a chart list that I already have built with the S&P Sector Spider ETF. So we're going to go here. And to the right, we can say View As a Summary. We're going to do View As Performance. What this does is it loads our performance table. This is a really good tip on stock charts, by the way, with any list. If you have a chart list of ETFs or stocks, you're looking at your portfolio, you're looking at sectors, asset allocation, whatever it is, put it in this performance report, and then you automatically have all of these different time frames. And all you need to do is click on a heading to rank the stocks or to reorder them, to sort them based on that column. So I'm sorting it on year-to-date performance in 2023. And without looking to the left, you probably know the sectors that, even though they've pulled back, they're still dominating. It's those FANG sectors, right? Consumer discretionary, communication services, technology. And indeed, those are the three that you see at the top: XLC, XLK, XLY. And on average, these are up about 35 to 38%, maybe even a little more for the XLC. And look at the gap between those three and everything else, right? A jump down to the S&P 500, which of course isn't a sector. I have it there just to give you the benchmark. The next sector after consumer discretionary up 35% is energy and industrials up 7.5%. So that's how big of a gap it's been between growth, particularly mega cap growth, kind of everything else. But now let's look at a 3-month performance. And if you sort it this way, what sectors have been strongest in the last 3 months? It's none of those three. It's actually energy. If you look at the last 3 months, AXLE, the energy sector, is up 15%. After that, it's communication services, consumer discretionary, both up about 5% over the last 3 months. Then financials, and then it's a gap down to healthcare, which is kind of in the middle of the list. But also notice some of these defensive sectors at the bottom. So this tells you, when we've talked a lot about the rotation away from growth leadership and into other things like cyclical leadership, like energy, this table kind of shows that really well. And it shows that there really hasn't been that rotation to defensive sectors just yet. But if you sort it on the last 5 days, we don't have month to date as a column. I would add that if I could. But if you look at the last 5 days, look at the top sector. Utilities up 4% over the last week. Consumer discretionary up 3%, and then there's a gap down to energy, financials, and healthcare. So it's kind of an interesting way to illustrate the dominance of growth year to date. The last 3 months, have you seen this resurgence in energy, but no real outperformance by defensive sectors, which is what would make me a little more concerned about longer-term market health. But then if you look at the last couple weeks, you'll find that some of the defensive sectors, particularly utilities, has really started to emerge. I think it's too early to declare that utilities are now the new leadership. Still a lot to prove there, but if you look again over the last couple weeks, you're seeing strength in utilities. We're seeing at the top of the sector return list. I think that's an important theme to watch, because if you see utilities continue to outperform, that is not a great sign for risk assets and particularly equities in general. Now, I'd mentioned in the introduction some of not everything is going up, right? We're seeing choppiness. We're seeing some charts still work, like Alphabet and Amazon come to mind, just these nice steady uptrends. But you also have stocks that are breaking down. We've highlighted some of the, like old telecom names like AT&T and Verizon, some of the other communication names like media names like Paramount breaking down. Airlines feeling the weight of higher oil prices. And when crude oil prices go up like this, and I'm asked, what does that mean? Well, again, it's hard to really declare a one-to-one thing, right? It never means if oil does this, these other things are definitely going to happen. I think of it in terms of headwinds and tailwinds. So higher crude oil prices, which we have experienced for, in recent months, what does that tend to mean? Well, it tends to be a good thing for energy stocks, which we're obviously seeing. Energy stocks going well. Anyone related to the price of oil being higher is obviously going to do very well. But think about who would not feel happy or not get the joy out of higher oil prices. Two things come to mind. Airlines, which is an expensive thing to keep functioning and requires a lot of fuel to fly around the planet. And also consumer, right? If oil prices are heavier, it's the implication that maybe people travel less and maybe they do less discretionary travel because it's so expensive to fill up the car at the gas station. For those of us that still drive gas-powered vehicles, so airlines certainly feeling some weakness. The Jets ETF is a great way of just showing at the airline space overall. And what's interesting, if you take a trend line from the October low and the April and May lows, you can see we broke down through there. Also the 200-day moving average just here in the last couple weeks. We've accelerated lower this week, but again, that's just the latest down step in a stepwise motion out off of a peak in mid-July. Individual stocks mirror that sort of short-term weakness. American Airlines actually back down toward the lowest levels. It's actually testing not exactly the October 2022 low, but that's not too far below current levels, about $1 away from where we're at right now. United Airlines as well, just breaking down through the 200-day moving average over the last week. Alaska Airlines, which is our biggest carrier here in the Seattle area, down at the lower end of the range. So my contrarian hat, which I don't wear often, but I can dust it off and pop it on for a moment, I'm seeing things like Alaska Air Groups. I'm seeing things like Southwest Airlines. These are at the lower end of the range for multiple years. Is this a time to reset and ride these things higher? The challenge to that thesis are higher crude oil prices. If you see that continuing, which I think is probably most likely, it's going to be tough for airlines to have as much of a profit if the fuel costs that much more. We're going to take a quick commercial break. We'll be back with my guest, Julius Kempenaer of RRG Research. We'll see you in a minute.
Investing is hard, we make it easy. StockCharts' technical scan workbench provides members with the tools to instantly find opportunities in the stock market. Run your scans on over 50,000 symbols in our database to help streamline your investing workflow. Using custom scans enables you to find new trades and investments in seconds. Predefined scans let you access our extensive collection of pre-built bullish and bearish technical scans. See what's moving the markets and find essential charts to watch by following our predefined technical alerts. Predefined scans make life easy to filter the market for promising opportunities. Scheduled scans let you set any of your technical scans to run automatically at a specific time. You can choose to save the results in a brand new chart list or into an existing list from your account. When your scheduled scans run, you'll automatically receive an email with a link to the day's results. StockCharts, built to empower the modern investor.
Hey everyone, welcome back to the Final Bar. I'm your host, Dave Keller, here at StockCharts.com. We so appreciate you joining us every weekday after the close. Excited to have a guest here in the studio. Julius Kempenaer, founder of RRG Research, is going to be joining us here in a few moments. Before we get there, a couple quick reminders. First off, we would love to hear from you. We so appreciate your feedback on our show, on our guests, on your host, all of those things, but especially your questions. What are you running into as you are trying to analyze the charts, as you are trying to apply the technical analysis toolkit every trading day? Our email is thefinalbar@stockcharts.com. We're on the Twitter @FinalBarSCTV, and on our YouTube channel, of course, just put a comment below the video you're watching. We would love to hear from you. Hope to answer your question in our next mailbag segment, which will be Friday's show of this week. Also, as a reminder, we had a great live Q&A earlier today, as I mentioned. Every Wednesday, 1 p.m. Eastern, I head into our podcast studio. We have so much fun, really a wide-ranging discussion. We touched on a lot of different topics in 30 minutes. I hope you will join us for our next one. Go to our YouTube channel called Stock Charts TV and make sure you look for the live upcoming broadcast. You'll see every Wednesday at 1 p.m. Just set a notification. You won't miss next Wednesday's live Q&A. I want to welcome on today's guest, Julius Kempenaer. Julius is normally coming to us live from Amsterdam, the Netherlands. He's coming to us live from a few feet away from me here in Redmond, Washington. Julius is the founder of RRG Research. I'm so excited to consider him a colleague here at StockCharts.com. Julius, so good to see you and welcome back.
Thank you, Dave. It's great to be back here.
It's good to see you. It's been a pleasure to get to know you over the years, and of course, I think incredibly highly of your work, as I hope you well know. I'm excited to get the viewers a little bit of a taste of what you're seeing here. We were debating in the Charting Forward special, which we recorded earlier this week, just this idea, the tension between offense and defense, and just strength versus weakness, thinking about the corrective pullback sort of move we're in versus the bigger picture. Can you use the RRG methodology? Kind of talk us through what you're perceiving here in September.
Yeah, absolutely. And I want to start at a slightly higher level.
Yeah, please.
So at the asset allocation level.
Yeah.
I'm not sure whether everybody who's using stock charts knows that that's available. If you go on the RRG page, there is a drop down with a number of predefined universes, and at the top is asset allocation. And that's the RRG that we've got right up here. And that shows you a number of ETFs that track a number of asset classes. And I use VBINX as the benchmark. And that's a Vanguard Balanced Index Fund. That's a classical balanced index, 60% stocks, 40% bonds, which is used by a lot of RIAs, investment managers, as their benchmark. So what we see here, we took off the Bitcoin tail because it's really long and it's kind of distorting the image. It's going very low into the lagging quadrant. So the ones that catch the eye here are the two big ones at the top. That's the two commodity ETFs, GSG and DJP. One is more heavy on oil than the other. Yep. But the bigger picture here is the revival of commodities, I would say. So compared to the other asset classes, you can really see how commodities are picking up strength again on a relative basis. Yeah. If we go to the stock bond comparison, then we have SPY, so that equals the stock side on the right-hand side, coming out of leading into weakening, and then there is Bill, SHY, and IEF. Those are government bond, different maturities on the curves, and we have LQD, corporate bonds, and we've got HYG for high yield. And you see that fixed income complex moving up and bonds coming down, so that's depicting the kind of setback that we're going through. But more importantly, I think, is that you can see how far away they are from the 100 level on the RS ratio scale. So SPY is still way on the right, and those fixed income things are way on the left. And that still shows you that there is a preference for stocks over bonds. Another takeaway that you can get from that is the really short tail of SPY. And a short tail on the right-hand side tells you that it is a very stable relative uptrend, which is pretty much what we got in our head. Stocks are doing well, they're doing relatively well versus VBINX. So they're going up and down. And the fact that we're now going from leading into weakening is just that little your rhythm of higher highs and higher lows that you're seeing in your relative strength lines. So for me, from a high level perspective, I'm still in favor of stocks over bonds, and I'm keeping an eye on commodities, they're a smaller asset class, but they're
Starting to
becoming
improve.
more important. Yeah.
And I know you designed this beautifully so that things rotate just as you kind of assume that they do in your head. You've visualized that well. But to be clear, further to the right basically means it's outperforming. So the fact that the SPY, even though it's coming down, the fact that it's so far to the right seems the long-term trend is still outperformance. Right?
Yeah, if you would take one metric off this chart, it would be the RS ratio, which is the horizontal scale, and the high numbers are good and the low numbers are bad.
Yep.
All the others, so the movements on the RS momentum scale are momentum moves, so they're kind of oscillating around that 100 level. And the strongest that you can see on an RRG is a rotation from leading to weakening back to leading, because what it means is that you are starting a new segment, a new up leg in an already established uptrend, so you don't have the risk of a turnaround situation that could fail.
So kind of rotating clockwise to the right side of the y-axis.
Absolutely.
Right? Yeah. Where do you want to go next? To sectors and look at the...
if you go to the sectors, and as you said, we discussed yesterday in Charting Forward, and it's a it's a theme that comes back more often, is the relationship between offensive and defensive sectors. And if you make that a monthly RRG, we've got that on the platform since a couple of months. We added, at the beginning we had only daily and weekly, but we've added monthly, but also intraday timeframes. But the monthly is super interesting, because if you look here, then you can see in the top left, so the three that are really on a strong heading are consumer discretionary, XLY, technology, XLK, and communication services, XLC. And they're all moving into that top right-hand corner. That's strength. Their money is moving into those sectors. And if you check where it's moving out of, and then there's energy there way on the right. It's a bit of an outlier on this monthly. It's an outlier on pretty much every chart at the moment. But the defensive sectors, so utilities, staples, and healthcare, they're right there, in that weakening, and then on the red one is just crossing into lagging.
Sure.
Those are the defensive sectors. So this beautifully shows you that money is moving out of defense into offense on a monthly RRG. And this is really long-term trends that we're looking at. And if you then switch to the weekly, you can actually see that they're confirming that sort of move. You got energy again way at the top there. But if you look at where technology, utilities, and communication services, they're now on the bottom right-hand corner. And remember what we talked about with SPY, leading, weakening, back to leading. All these three sectors have been leading the market higher. They're now going through a little bit of a momentum setback, but you can see that there is plenty of space before they would cross over to the left-hand side of the chart. So there's all the opportunity for them to start curling back up. Actually, XLC is already doing that. XLC is already in the process of moving back up higher. So these three sectors, and together, they make up 47% of the market cap in the S&P. So if almost half of the market cap is ready to turn back up, I think that means something. I think that is a positive undertone for the market as a whole, especially knowing that here also money is rotating out of defense again.
Well, I was going to say, I'm noticing utilities, consumer staples over here farthest to the left, kind of still in this area, underperforming quite a bit. So again, sort of rotate. It shows that relative.
Yeah, and then that XLU, if you look at the price chart of XLU, it's actually breaking down in price as well. So
absolutely.
If you're a defensive sector and you're breaking down in price, and you're kind of the worst on the RRG in relative terms,
Not ideal.
That's not a good thing for you, but it's a good thing for the market, because people don't like utilities, they don't need the defense in their portfolio, meaning that they're allocating their money somewhere else.
Got it. Okay. Where next? Do we want to look at a shorter time frame, or do you want to dig into one of these sectors?
We can go into the we can do both, but just go to the daily on this one, because it's sort of it keeps reinforcing each other. If you see XLK is inside leading, but going through a bit of momentum, but see how far it is to the right. Again, XLE, an outlier there on the right-hand side, but strong rotation, long tail, a lot of power behind that move. If you look at XLC, that's the one that's going right into there. So you can see how that rotation is picking up that strong RRG heading, moving into the leading quadrant, so underscoring the current strength. And then we got consumer discretionary, XLY, which is right pushing into that. So you can see how these three that we saw on the weekly inside weakening, and we were talking about how they could rotate back up, it's already starting here on that daily RRG. So that's all, if you bring that all together, all that mix together, then I think that it's really, underscoring the strength of the market by money moving out of defense into offensive sectors.
So I want to look a little deeper. We talk about communication services. I'd love to dig into there just here in a minute. Just quick though, I mean, what would you be looking for with all these to summarize? What we have not seen is the performance in defensive sectors. And I mentioned in the recap, like utilities, at the top of the list today, but it's still been underperforming for so long. What would you need to see in these to really start to see a danger sign that things are getting worse? Is it focusing on things like XLU and XLP and others showing better relative strength? Is it a break from the growth leadership? Is it a little of both? What would tell you?
I would say the things that I keep an eye on in terms of offense defense is when, especially on the weekly RRG, you see real improvement in these three defensive sectors. So when you see utilities, staples, and healthcare starting to move in tandem, in line, and especially the RRG heading. So not necessarily where they are on the plot, but when they are starting to move into that, the heading is what we call basically a vector between 0 and 90 degrees. If you look at a compass, the center, and then it's the previous observation to the current observation. So not necessarily the center of the chart, but the previous observation to the current observation. When that is at a vector between 0 and 90 degrees, that is when things start to improve. Because what's happening there is that they are picking up both in terms of relative strength and in relative momentum. And that's where you see the improvement. And it can happen in lagging, it can happen in improving, can basically happen everywhere on the chart. But we've learned that is that's an important metric, an important thing to see. So when that happens with these defensive sectors, that's a warning sign. Like, start paying attention.
I got it. We only have about a minute left, but I'd love to look, Julius, because we can run RRG on individual stocks. Here we're looking at the components of communication services. What are your takeaways as you view all this group of names?
It's an interesting group because it's the strongest because it has already started to move back up. But when you look at this, there's a lot of stuff on the left-hand side, and usually it's not a very good sign because that means that they're underperforming. So the group is good, but there's quite a bit of individual stocks that are on the left-hand side. Doesn't mean that they're underperforming SPY. It means they're underperforming XLC. They're grouped here. But what is more important is that you see Google, Goog and Google. They're right there. So they went through that leading, weakening, and now back into leading. And you got Meta, which is on the bottom right, and that's leveling off, and again, very likely to start rotating back up. These are the major stocks in that sector. So this XLC is going to be driven back, so to say, I guess, with these mega cap names. And they will definitely, drive the XLC as a sector, but you got to be picky inside the sector which ones you take. If you for whatever reason you leave out the mega cap names, you might be surprised with your performance later on. So so always, when you have this drill down, the final check is always your chart, your regular price chart, and I always check for breakouts to the upside. If something's looking really good on an RRG, but it's like pushing against resistance, I'm just going to wait until it breaks resistance. I'm not going to just rely on the fact that it looks good on an RRG.
No, good point. And I've always found this isn't, for me, this often leads me to some really good questions to ask about some individual names and what's the right timing to some of the trades. So this sets the table on showing you where you want to focus and then use it along with some of the other technical tools that we have. What a great illustration of big picture from top to bottom, looking at asset allocation to sectors to individual stocks. Good to have you here. Good to see you, Julius.
Thank you, man.
Yeah, we'll do it again sometime. We have to wrap the show, folks, and go to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. Here we go with chart number 1. We're looking at what I call the new Dow theory. And when we talk about stocks and particularly the equity indexes, Dow theory was really just a very simple way that Charles Dow created to look at different parts of the economy, different pillars of the economy, and gauge their performance, right? When both indexes, at the time it was the Dow Industrials and the Dow Railroads, when they were both doing well, economic conditions were good. When they were both struggling, economic conditions were bad. When things were disagreeing, when one would break out and the other wouldn't, that was called a non-confirmation. That would tell you maybe something is awry. If you look at the NASDAQ, and I'm just simply drawing a trend line on a closing basis from the low, and on a closing basis, actually made a new low in December of last year. You'll see that lines up with the March low and the April low. that actually connects pretty well with the August lows and not too far below current levels. So when you do some trend line analysis off of the lows, the Nasdaq Composite looking a little weaker in terms of, very, very close to breaking down a key trend line. And what I was taught is the more that the price tests a trend line, the more it's validated. And the reason why I'm mentioning that today, because Ralph Vacampora, a mentor to both Julius and I, will be in our studio here tomorrow, and we'll be talking about some of those basic founding principles of technical analysis. Some of the tools that Ralph used 50 plus years ago, I think are still very relevant, drawing trend lines to recognize a trend that is in play and recognizing when that trend is different, I think is super valuable. Chart number 2, I thought Julius Kempenaer did a fantastic job illustrating the RRG methodology and really as a way to brilliantly describe relative performance across sectors. I was looking at the sector performance tables earlier. I think another way to just sort of illustrate some of those movements over different time periods. And when I'm looking month to date, so starting the clock at the end of August, right before the Labor Day holiday, and then looking to where we're at now, look at the sectors that are doing well. Here is energy up about 3.8%. You can see utilities. You can see, I think that's XLY up there as well, 1.4%. But here's the S&P. Here's technology. These are the sectors in consumer staples underperforming. So, noting the sectors that are working, recognizing where there's renewed strength and focusing on those opportunities, I think can be very, very helpful. We're in an interesting situation where the sectors at the top of the list are energy and utilities. That is a very different look than the first quarter of 2023, for example. But again, I would use the RRG to look at those different sector relationships and anticipate when those relationships may be changing. Finally, I am always looking out for candle patterns. I have alerts set to highlight particular candle patterns. I use the predefined candle scans on stock charts often just to focus on individual names on the move. I'm highlighting two that today are featuring what's called a bullish engulfing pattern. And if you don't know your candle charts, this is where you have a down day followed by an up day. The body of the candle gives you the open to close range. So day 2 engulfs the range of day 1. You find that on CRL. You find that on Waters Corp. Those are two healthcare stocks. And what's interesting is healthcare is a space I think a lot of people have loved to forget recently. It's been sort of in the middle, right? It's been growth leadership. It's been cyclical leadership. Healthcare's been kind of choppy, sloppy in the middle. Bullish engulfing patterns like this tell me to maybe revisit those as a potential idea, both of those suggesting short-term strength in those healthcare names. Folks, that's a wrap for this show. Thank you so much for joining us every weekday after the close for the Final Bar. Special thank you to Julius Kempenaer of RG Research and our Stock Charts colleague for joining me in the studio. Not thanks for this little sign thing. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.